Hey, good morning, everyone.
Hello, good morning, sir.
Good morning, sir.
Hey, good morning, Hemant. Okay, so let's start with the session for today. Let me just share my screen to begin with. Okay. So in the last class, we discussed about what would be the treatment for the balance sheet and the profit and loss account item. We started with that, and we ended the class with respect to how the accounts receivable would be accounted for. There are a bit of a significant things which you need to remember when it comes to kind of an account receivable analysis, and that is one of the important things which is which would be there in your examinations to some extent. So let's just try to quickly revise that thing, and then we can move forward with the other things. So when it comes to accounts receivable, there are a few things which you need to understand basically. Is accounts receivable, they always have a terms or a payment terms which is already always quoted in the invoice. So it could be like 2 by 10 and n by 30. We discussed this. So what it means is you pay me within 10 days, you get a 2% discount. You pay me within 30 days, you get no discount. So that's the one of the terms conditions which might help you in analyzing the question. So you get a 2% discount, you don't get a discount. So that is kind of a discounting term which is there. But then the most important thing which is kind of very relevant for you in your examinations is how to determine what is the credit loss amount, what is your closing balance of allowance. There is a credit loss amount, there is a closing balance, and what is the collection, what is your credit loss expense. So these are some of the four key elements which usually are being asked in your examination with respect to your accounts receivables. And how do you find those? That these four elements is based on the calculation method which you're using. So there are two methods to calculate it. The first one is called as percentage of credit sales. The second one is called as percentage of receivable amount. What is the key difference between these two methods is the percentage of credit sales will give you directly the credit loss amount. So it will directly give you the credit loss amount. So if your question asks you that the company is following a credit, like a percentage of credit sales method, what is the credit loss amount? And if you have the credit sales given to you, you can just take a percentage of it and get an answer. So I'll brief you on with an example as well on this. And what your percentage of receivable amount or recoverable amount gives you, it gives you the closing balance of your provision account. Okay, so it depends what kind of an information is requested to you in the question. So let's take a quick example wherein we can understand like how this technique is going to work, or how this basically fits the things in place. Is that, let's assume that the opening balance of my provision account is say $5,000. Okay, the collection given to me is say 4,000, and the first question which is being asked to me is, okay, I'll just give you the sales. So the credit sales is equal to say 100,000. And the first question which I need to answer is, what is my credit loss expense? So this would be credit loss amount. You can just put it as credit loss expense amount. So there are two different terms which wherein we need to concentrate on. This is your credit loss expense. So what is my credit loss expense based on this situation? It would be, because you have credit sales given to you directly, the next question should be which method the company is using. Which method the company is using to calculate its provisions or calculate its losses. So if it is, let's assume that it is percentage of credit sales, then what is my credit loss expense figure? The credit loss expense figure would be the credit sales multiplied by the percentage of credit sales which the company wants to assume as their provision. So when it says that it is using the percentage of credit sales, it will always give you a percentage as well to do it. So percentage of credit sales would be say 5%. So then your answer would be the amount of credit sales multiplied by 5%, and that gives you 5,000. Let not keep it 5,000. Let's keep it 4%, because yeah, this becomes, sorry, not 4% also, because we already have it in collection. Let's keep it 2%. Yeah. So percentage of credit sales is my credit loss expense amount, and that would be percentage of that credit sales overall, and that is 1 lakh into 2%, that gives me 2,000. Okay, what if the company is following percentage of receivable amounts method? What if this method is being followed? In that case, you cannot calculate the figure directly, because that's not how the method works. But what you can do is you can create an account, do some math, and then get an answer for your credit loss expense. Okay, so let's quickly do that, how it is going to work. So for that, what you need to do is you need to draw in your kind of a rough copy, or somewhere in your workings, is you need to draw a credit loss allowance account, allowance for a credit loss account. In the layman language, or in our 10th, 12th BCom, we also call it a provision account. Okay, so if you just want to make the things comparable. So what you do whenever you have a question with respect to this accounts receivable and calculation of your allowances, calculation of your credit loss, closing balance, collection, whatever it is, you always draw a quick account in any of the scenarios. So whenever you see accounts receivable, you draw account. That's it. That's your first primary step, which should be going in. Then what happens is you put your opening balance. So don't put the figures, just put the criteria. So just put opening balance on the right hand side. Go with collection, and this will be your credit loss expense. So what you do is you just keep the template ready with you always. So this would be your credit loss written off. It would be a single one. So this would be your credit loss written off. You have opening balance, you have closing balance, you have got collection, and you have got expenses, credit loss expenses. Now what you do is now you read the question and find out as to what is the requirement of the question. So for example, if in the first scenario we are being asked that, look, we need to calculate the credit loss expenses. That means what we require is this figure is required for us. Now the second question should be which method the company is using to calculate this, or which method the company is applying for this provision account. Because the company was using percentage of credit sales method and you have got credit sales available with you, you can directly multiply the things and get the answer. That's it. Don't have to do anything else. Okay. But in the second scenario, what we have is the company is not using the percentage of credit sales, it is using the percentage of recoverable amount or the receivable amount. So in that case, what is going to happen is the answer which you are going to get by this multiplication is percentage of recoverable amount or receivable amount. So let's say it is 12%. So for that, the question would always give you the balance of accounts receivable, because without that, that calculation is not possible. So balance of accounts receivable or accounts receivable outstanding at the end of the period, something related to accounts receivable would be given to you. Let's say it is 2,50,000 or 250,000. Then the percentage of recoverable amount becomes 12% of this. That is 30,000. And this 30,000 is not your answer. It is still not your answer. It is your closing balance. It is your closing balance. So once you have this and the other information which is available in the question, so opening balance is 5,000. Collection, it says, is 4,000. And there is no information given to you with respect to the written offs. So there's a difference between the written off and expenses. So just make yourself pretty segregated on these points. There is a difference between credit loss written off and credit loss expenses. Okay. When you would be using these two terms in your normal kind of a business jargons, both of the things usually go into profit and loss account. Usually, I'm saying. But for IFRS or for a US GAAP, and when you're following a allowance for credit loss method, it is the written off amount will not go into your profit and loss account. It will be adjusted in your accounts receivables directly. Okay. So what happens is whenever I say that inventory is written off, usually what strikes to your mind is it is a loss for me and it should go into profit and loss account. That is correct, provided you're accounting it in a more simpler way. But because we are using allowance for credit loss account and we have methods to account it for, the accounting is not direct, it is an indirect accounting. So because you don't have a credit loss or a credit written off figure, you can just assume it as 0. And the balance of this would be your credit loss expenses. So this would be 30,000 plus 0 minus 5,000 and minus the 4,000. That becomes 21,000, and 21,000 plus 4,000 plus 5,000, that gives you 30,000 as your ledger tie out figure. Okay. So that's how you need to approach. So there could be a possibility that what the company will do or what the question will do is that they will give you the credit loss expense figure and they'll request you to calculate any of these balancing figures. Either they'll tell you to calculate collection. So for collection, it is always the balancing figure. Opening balance, it is always the balancing figure. Closing balance, it depends on the method if you have, or it could be a closing balance. It is method or balancing figure. And credit loss expense, it is either method or balancing figure. What about credit loss expense or credit loss written off? It is always the balancing figure. So this is something which is a bit kind of a complicated thing where you need to understand the things. Just to make sure that the things are working smoothly, I can write an entry for you. So when you write off this credit loss written off, this goes directly into your accounts receivable. So the entry would be allowance account is getting debited and the credit for this would go to accounts receivable account. The credit goes to accounts receivable. So debit is into credit loss account, credit goes to accounts receivable, and accounts receivable is your balance sheet item. That's why in your MCQ question, it will ask you in such a way that the company has written off its credit losses. Will it affect your profit and loss account? That would be the question. And your answer should be no. Because when you write off credit losses, it doesn't affect your profit and loss account. It affects your balance sheet because it affects your accounts receivable. It will also ask you whether an expense is getting recorded when you do a credit loss. Does it affect your profits? No, it doesn't affect your profit. It affects your accounts receivable, meaning it affects your balance sheet only. Okay. Then for your credit loss expenses, so there is credit loss write-off, there is credit loss expenses. The credit loss expense would be going into your profit and loss account. So what is happening is you're crediting your provision account and then you're debiting your P&L account. That's the entry which you're going to pass. So the question would be, when you record a credit loss expense, does it affect your balance sheet? The answer is no, it doesn't affect. It only affects your profit and loss account. Because the entry says that it is debited to profit and loss account and it is credited to your allowance for credit loss. For collection as well, does your collection affect your accounts receivable? Does collecting an amount affects your accounts receivable? The answer is no, it doesn't affect, because you debit the cash account and you credit your allowance account. So just make sure, if whenever the question is telling you does it affect your balance sheet, just make sure that that entry has a balance sheet item involved into it. If it has, it will affect. If it doesn't have, it will not affect. Okay. So that is something which you need to remember. And the best way to remember is to just draw these 5 items there. Whenever there is a question, the first step would be, if it is a question related to your bad debts, credit losses, accounts receivable, just draw this account. When you draw the account, the next step should be just to mark all these items. All the main items, whatever are given to you in the question. So these are the items. And whatever information is given to you, just put the figures initially. Then ask yourself what is asked by the question. Does it have a method for it? If it has, it will either give you the closing balance, it will either give you the expense figure. And the rest of the things can be taken kind of a balancing, can be taken as a balancing figures. And then if there is a question, if by passing an entry for credit loss write-off, passing an entry for credit loss expense affects your balance sheet P&L, it depends on which entry the question is asking to you. Either it will tell you either it affects your balance sheet P&L, or it will specifically tell you whether it affects your accounts receivable, whether it affects your uh, accounts payable and all. So all these kind of things the question is going to ask you. But once you have this in place, you can just make sure you have it like a template based on it. So this was regarding your accounts receivable. The major part is covered in your CMA part 1. How to understand accounts receivable and all is only until your FMAA part. So for FMAA, this may not be that relevant, but for your CMA part one, probably I guess it is in part two as well to a certain extent. Uh, that is something which is kind of an important thing which you need to understand. Then the second most important kind of a thing in accounts after accounts receivable is your inventory. How to value your inventory. So first of all, guys, there is a very basic thing which you need to remember when it comes to inventory. The inventory always has three elements to it, and that is very important when you do your budgeting thing. So it is basically somewhere related to budgets. First is the finished product. The second is your raw material. The third is your work in progress. So these are the three basic elements which an inventory has. So for your kind of study purpose or until you are doing your notes and all, just make sure whenever there's an inventory question, you should be able to segregate what is the raw material and what is the finished product. So let's say mobile is my finished product. For that, the raw material would be the screen, the IC conductors, and the motherboard. These are my raw materials. So you need to always be in a position to segregate. If you cannot segregate what is your finished product and what is your raw material, your inventory calculations are going to go wrong. Because this is your kind of items, and then there is a unit to it as well, like the measurement. So the measurement of your finished product would always be in units. Finished products are always in units, number of units, but your raw material would always be in numbers. And if it is using some kind of other parameter like kgs, liters, millimeters, centimeters, it would always have that. The work in progress is something which is a mix of your finished product and raw material. But then it will always have your finished product into it because it is in process of making a finished product. So mobile, it would, and then there would be a percentage of completion to it. So when you have an inventory in place, whether you're working, whether you're studying, the first thing which you should always be able to segregate is what is my inventory of the finished product and what is my inventory of my raw materials. If you cannot segregate it, you cannot solve these questions, or you will not be in a better position to solve these questions. Then what are the problems with inventory we have? Okay, the basic problem with your inventory is it becomes obsolete. For example, if it is a perishable product, it will be perishable versus non-perishable. If it is something which is out of technology, it would be absolute. So for example, the typewriters or the pager phones, the old mobile phones with buttons, they're all obsolete inventories. Then there is something called as FOB, that is freight on board, shipping, and then freight on board, destination. So what it means, it is just a small concept, whether you for fixing your liabilities. So if you want to travel from point A to point B, so you're traveling from, let's say, USA to Mumbai. Let's keep it as USA to Mumbai or India. And the inventory conditions or the freighting conditions of your inventory is FOB shipping. That means until this point, until it is being shipped, the responsibility fixed on the seller or the supplier of the product. If it is FOB destination, the responsibility of the whole kind of stuff is still on the supplier, but the point is different. The exit point, the responsibility point ends in India and not in the US. So, for example, if it is FOB shipping, that means as soon as the product is shipped, the responsibility of the supplier is over. So, if you are a company and you are sending your inventory to India and your contract terms are FOB shipping, that means as soon as you ship the product, your responsibility is over. Now, from this point, that is from the as soon as it leaves USA, like this point, the whole responsibility would be with the other party. But that is not the case if it is FOB destination. For FOB destination, until it reaches the destination, the responsibility lies on supplier, that is at your company. So it depends on the contract terms which you are using. That's what you do by putting it as FOB shipping and FOB destination is you fix your liability and you fix your liability point. My liability is until this point, then my liability changes. So what is that point? That point is being decided by FOB shipping or FOB destination. So it's a small thing, no, not much to calculate, but then just information which you should remember. Then in inventory, we also have methods to calculate. So for method, we have got FIFO method, we have got LIFO method, and we have got weighted average method to calculate these inventories. And in every method, there is periodic inventory and perpetual inventory. So there are three main methods, which is FIFO, LIFO, and weighted average. And under every method, we have two sub methods. So which method the company is using? Is it using FIFO and perpetual? Is it using FIFO and periodic? That means there is a difference between these two methods. So what does your periodic method tell you? Is what the way I have remembered it is balance sheet, date, pay, counting, uh, accounting, that is the inventory valuation or the inventory kind of a reconciliation will happen only at the balance sheet date. मतलब balance sheet date पे counting होगा इसका, simple. So for example, whatever is your balance sheet date, until that date you don't give a physical count of the inventory, the whole system will automatically be working upon. You don't revalue the things until that date. What happens in perpetual is it is like a running balance. Every time there is a problem or every time there is an issue, you revise your inventory. So what I mean by that is, let's say the opening balance of your inventory was 1000. You added a few units. So you added some units on 5, 10, 12, 14, 15, 17. Let's say you added, these are the dates when you added the units. And the units are like 5, 10, 15, 20, and let's say 50. And then you sold some units. Okay. And then there would be a selling date as well. Let's say it is 11, 18, 21. And you sold a few units. Let's say 10 you sold 20, then you sold, let's say 5. So the whole valuation, if you are using a FIFO method, and if it is a periodic FIFO method, then what is going to happen is, so it is FIFO, it is periodic. What is that point wherein you do kind of a reconciliation as out of how many stocks we have already used and at what rate? So these are the units, and then there is a rate as well at which it was purchased. Let's say it was purchased 1, this was at 1.2, again 1, 0.9, it was purchased. and you've purchased this for, let's say, 1.5. So what is going to happen if you have sold? We need to reduce it. Let's reduce it to 4 units. So what you need to do is, now because you're doing an inventory valuation and you're using a FIFO method, what it means that the first stock which you have is being sold out of the prior stocks. So if you're going to sell 10 units, it would be 4 from this, 5 from this, and 1 from this. Okay. And then there would be a consolidated rate which would be given to you in the question as well. So now what happens? What is that date wherein you reconcile the things? What is that date? So that date would be the balance sheet date. Or for balance sheet date, I don't mean the year end. It could be month end as well. Month end balance sheet date, it could be that way. So for example, 31st of July is your month end date or the month end balance sheet date. Then at this point, you calculate your what is your FIFO inventory balance. So you do it 4 plus 5, and then there is plus 1 from the 10 stock, this one. So what happens is this becomes 0, this becomes 0, and this becomes 9. And then the whole calculation takes place at balance sheet date. And it is not going to happen the moment you sell it. For example, if you sell it on 11th, you don't have to recalculate the things. You only calculate at the end of the balance sheet. But if it is a perpetual method, on every sale, you have to recalculate the value of inventory. So for example, there are 3 sales, 10, 18, and 21. On each day, you have to calculate it because you are using a FIFO perpetual method. If you're using the LIFO method, the same thing will happen, but it will be last in first out. But usually LIFO method is not permitted nowadays, so don't worry about this method that much. And then there is weighted average. So what weighted average does is, I'll tell you. So there is a small difference between perpetual and weighted average, or kind of a periodic and weighted average, is that when I am going to value my inventory for periodic method, so let's say it is periodic method, and I have sold 11 units. So how would I be recording it? So 4 units are sold at the rate of 1, that is this rate. Then 5 units are sold at again 1 rate, because that's the rate we have. And 1 unit is sold at 1.2. That gives my 10 units at multiple rates. And what would be the value according to the FIFO method? It would be 4 into 1, that is 4, 5 into 1, that is 5, and then it is 1 into 1.2. 1.2, it is your answer. And this is your value of inventory for the unit sold on 11th. That is your COGS, the cost of the goods sold. What if it is a LIFO method? You will have to just make sure that it is in the reverse order. Reverse order as in from this. From 11th, you will have to calculate the reverse order. So on 11th, you sold 10 units. That means all the 10 units should be valued at 1.2. Because that's the only balance which is available with you. So for that kind of a problem, it would be 10 units being directly sold at 1.2, and the value will be 10 into 1.2, that is 12. So this is your LIFO, this is your FIFO, and both are periodic. But if you want to calculate it on a perpetual basis, the first time you calculate the periodic and perpetual, it will always be the same. The problem happens in the second one. So there is a timing difference now. So for periodic, it's only it's only one calculation you have to make, but on periodic basis, on perpetual basis, you have to make a multiple calculation on every sale. And what happens when there is a weighted average? So if you want to calculate a weighted average, then what is the point of sale? That is 11th is your point of sale. The day 11th is your point of sale. So what you will have to do is you will have to multiply the cost in order to calculate the weighted average cost. So what you do is 4 is your units multiplied by its rate, that gives you 4. Don't use this rate, just park it somewhere. 5 into 1 again, so that becomes 5. That's the rate which you already have, and then there is 1 into 1.2, that gives you 1.2. So what you do now, you take number of units, that is the total of units, that is 10, and you take the overall dollar value, which is 10.20, and then you divide this, the value divided by units. So 1.02 would be your weighted average rate, like weighted average cost, which you need to apply to these 10 units. If you see, the overall value will basically be a bit different in terms of the rate, and that rate would be used to calculate the COGS. Okay, so this is something wherein a bit of a practice is required. We have a questions in your part 1 as well on this, like a more detailed stuff is there, but this is just a kind of a quick overview. So when it comes to inventory, the first thing is decide whether it is finished good, raw material, or work in progress. The second thing is, what do you mean by FOB shipping and FOB destination? What are the problems in the inventory? The inventory becomes obsolete, and then it becomes, if it is a perishable, it becomes destroyed because of its perishable nature. Then there are methods. One is FIFO, LIFO, and weighted average. And in every method, we have got periodic and perpetual. What is the difference between periodic and perpetual? Periodic happens at the balance sheet date or a specific date only. And perpetual, it is like a running balance. On every sale, you have to recalculate. On every sale, you have to recalculate. And what happens with weighted average? You need to calculate the total of, in terms of dollar value and units, and you need to find out a single rate. You don't want these different rates to be applied. You only want a single rate to be applied. But then once you do this method of valuation or methods to calculate your inventory balances, there is something called as balance sheet valuation. So inventory on the balance sheet date. So once you have the values with respect to your FIFO, LIFO, weighted average, whichever method you are using, you get a value from that. And once you get that value, will you still be able to compare it and put it into your books of accounts? The answer is no. Before that, you will have to make another comparison. So the method is like this. So identify your methods, that is FIFO, LIFO, and weighted average. And based on whatever method you are using, come at a dollar value of your inventory. So that is something which you have calculated as per your books. Call it as a cost, right? But because we have got US gaps coming in, they have their own applicability. We'll not just blindly take up this value. We'll compare this value with NRV, that is the net realizable value, and whichever is lower of these two, we'll take that as our final value. So even if you get a value, so for example, even if I get this 10.2 as my value on the balance sheet date, I will still not be using it. I'll still have to compare this value with my net realizable value, that is NRV, and whichever is lower. For example, my net realizable value is coming to be 9, then 9 would be my final inventory value going into my balance sheet. Okay, so this is something which you need to remember. So how the flow works is you identify the number of items in the inventory, you identify what is FOB and FOD, you identify the distinction between perishable, non-perishable, obsolete products, You identify the method, FIFO-LIFO weighted average. Once you have all this in place, you get a value of cost. So that is the cost as per your books. So this is the cost as per your books. But then because inventory is a receivable amount, it should be compared with its net realizable value. And if its net realizable value is lower than its cost, it should be you should need to bring the value down to the NRV. And what entry you pass for this. So for example, your cost is 1,000, or let's say 10,000, and your net realizable value is coming to be 9,000. That means, although as per your methods, the value of the inventory should be 10,000, but if you go into the market as of today, you'll only get 9,000 from the market. In that case, what you do is you bring down your inventory by booking 1,000 as your written off inventory loss. And that directly goes into your profit and loss account, unlike your provision account. So see, that's the difference. Because in the inventory, we are not having any provision or any other kind of stuff, we directly book it into profit and loss account. This would be 1,000 would be debited to profit and loss account, that is P&L account debited, or you can put it this way: inventory written off account debit 1,000 to inventory account. Right. So inventory account is my asset. So asset is getting credited by 1,000 and my loss is being booked. Will this entry go into your profit and loss account? The answer is yes. But will this entry go into your profit and loss account? The one with in terms of your credit losses written off? No, it will not go there. So that's kind of a major difference, because for inventory, we are only following a single approach of accounting. But for allowance and accounts receivable, we are following a kind of a breakup entry system, wherein we break the entries into multiple parts to show the true picture. Okay. So just remember this. Again, inventory is also relevant for you in your examinations. Any questions anybody has on this?
No, sir.
Okay. But this only just let's try to grasp it a bit, so that once you go into your main tuitions, it would be much easier for you to analyze. So there is another thing which you need to understand is property, plants and equipments. What do you mean by PPE? Or in simple words, what do you mean by fixed assets? So for fixed assets, the definition says, so asset is something wherein you can generate future benefits. And what is fixed asset? It is usually non-movable. That's why it is called as fixed in the building. It's fixed, cannot be moved. The second is when you record your asset. When you record your asset, when it is ready to use. What you record is the total cost until it becomes ready to use. एसेट को रेडी करने तक का खर्चा आपकी कॉस्ट में आएगा. Simple words. Whatever is the cost which you need to make the asset ready for use, ready to use asset, that whole cost should go into the final cost of that asset. So in Hindi, if you want to remember it that way, the way I remember it is asset को ready करने तक का खर्चा सारा उसकी cost में आता है. Okay. And then when you talk about property, plants and equipments or fixed assets, and because these assets do not only have a span of 1 year or 6 months, it's kind of a longer span they carry. You cannot book the cost of the whole asset at one go. You need to depreciate it. What is the reason for depreciation? Is because the value of that asset is going to be spreaded over a few periods, like 10 years, 15 years, 5 years. And depending upon that, you depreciate the asset. And for depreciation of the assets, you have got multiple methods: straight line method, reducing balance method, sum of years or units of production. These are the 4 methods. Trust me, guys, I haven't seen sum of years methods or units of production method being used in my whole life, whole of my experience. The only method which primarily is being used is your reducing balance method, or probably straight line method to a certain extent. But this sum of years or units of production method are probably only kind of a theoretical thing. There are a few industries which might be using it, but I haven't came across any of these industries. So the formulas and all for this straight line method, reducing balance method, sum of years is already there in your notes. You can just have a view on that. But still, if you want me to, I can just write it there. For for straight line method, it is cost minus your salvage value, and then you divide it by your useful life. So what it does, it gives you a constant depreciation throughout the year. What reducing balance does is you need to identify the rate. You apply that rate, that becomes your depreciation value. So the cost minus the depreciation value would be your net book value. So cost less your depreciation is your net book value for the first year. And because you're using reducing balance method, so let's say this is 10, this is 100, this is 10% is depreciation, this is 90. The next year, what is going to happen is the depreciation of 10% will be applied on the net book value instead of the cost. So this would be the depreciation for the next year. So net book value. Then this basically will continue until it becomes 0, or until you sign off, you sell off the assets. Then it says sum of year of, or a sum of years of digits, sum of years of digits. So this is the formula says that depreciation is equal to n plus 1, and then divided by 2. So n is basically your number of years, and then you basically what you do is you proportionately divide it based on the cost. So instead of having it this way, it is better to remember it the way I have written it. So it is years, and then you need to calculate the proportion for every year. For example, if your useful life of the asset is 5 years, so you need to calculate the proportion. So how do you calculate the proportion? Is so it's a sum of years. So you do a sum of years first. This comes to 15, right? And then out of this, you give a proportion. So when you're using the machine for the first time, what proportion you get? So when you start using the machine, you still have 5 years left out of the whole 15 years of arithmetic time. So it becomes 5 by 15. So why 5? Is you started using the machine on the start of the first year. So first year is full, second year, third year, fourth year, fifth year. That's 5 years. That's the proportion you need to give. Once you are in year 2, at the start of the second year, you would be using it for 4 more years. This becomes 4 by 15. At the start of the third year, it becomes 3 by 15, 4 by 15, and 5 by 15. Oh, sorry, not 5. It should be 1 by 15. This is your proportion. there would be a cost of the asset which would be constant, and then whatever you get is your depreciation figure for that year.
Sir, after 3, it would be
Oh,
2
sorry.
by
Yeah,
15.
yeah, sorry. Yeah, it would be two, right? I'm so sorry for that. Yeah, it should be 5, 4, 3, 2, 1. Yeah, correct. So it's basically a arithmetical calculation wherein you might get a single question somewhere in CMA or FMAA, but not much to be worried about. And then there is something called as unit of production. Unit of production is same as your SLM method, wherein you have cost minus salvage value. And instead of useful life, you have production units divided by number of annual production units. So for example, if you estimate that in a span of 1 year, you would be producing 100,000 units. So you divide it by 100,000. The cost and the salvage value remains the same, but you divide it by number of estimation of your annual demand. So this is something which you can just have a quick glance over it. I mean, something that is not that important apart from your SLM and reducing balance method. But then something which is important for you in your fixed assets, which is there is a high probability that this would be there in your examinations, is you need to apply an impairment test. When I gave my exam, there was 3 questions on impairment test in my final examination I'm talking about. So it is important that you understand what impairment test means. So for that, you just have to make sure that you understand how the fixed assets and all work. So as I already mentioned that the fixed asset would be, there would be a cost of the asset. You need to apportion it in different years. And for apportioning that cost, which is depreciation, you have got multiple methods to do it. Every method has its own formula to do it. Sum of digits, like reducing balance method, straight line method, and whichever method you apply. So this is something which is a bit theoretical. But then the impairment test is something which you even do in your practical life. So what you do is how I remember it, I'll tell you. And if you think that that is a better way to remember it, you can always follow that. So what I usually do is I usually draw a balance sheet quickly, just to make myself understand the concept. Okay, so I have a balance sheet and I have an asset here in the balance sheet, which is a value of say 10,000. Okay, so what it means is the value of the asset. That means if I use this asset for whatever life it is, whatever is the left life of the asset or whatever is the balancing life or whatever, if even if I purchase it today, what is the useful life? Whichever life is available as on the balance sheet date, this asset is going to give me a revenue worth 10,000. That means what I am doing is I am doing a valuation of asset based on the definition of asset, which means the definition of asset says that what is an asset? Asset means that it is something which is going to give me future economic benefits. That's the definition of asset. So what is asset? Is equal to something which gives me future economic benefits. That means if the value of my asset is 10,000 in my books of accounts, it means that 10,000 is my future economic benefit from that asset. Let's say it is a machine for that matter. Okay, that means it is going to generate me a revenue worth rupees or worth dollars 10,000. And what impairment means, it's related to repairment or repairs, but impairing something means that it doesn't justify the value in your balance sheet. It doesn't justify the value in your balance sheet. What it means, if this value of 10,000 is not justifiable, that means asset which should give me a future economic benefit worth rupees 10 worth dollar 10,000 is not justifiable. So the question is it more or is it less? When you say something is not justifiable, that means either it could be more or either it could be less. The question is whether it is more or less. That is the test which is called as impairment test. So let me just explain you it in Hindi if you are comfortable. How do I remember it? मुझको इस एसेट से 10,000 का रेवेन्यू मिलने वाला है, लेकिन क्योंकि ये इम्पेयरमेंट टेस्ट मुझे लगाना है इसमें, तो ये 10,000 जस्टिफाइबल नहीं है. The value is not justifiable. This value is not justifiable. Okay. So this is the book value, which I am telling that it is not justifiable. Then, अगर ये justifiable नहीं है, तो क्या justifiable है? So the carrying amount is justifiable. Sorry, not the carrying amount, the cash flow amount. If my assets value, that is 10,000, which is called as book value or carrying amount, either way you can call it, the both are the same, is not justifiable, then what is justifiable? Justifiable value will come from my cash flow. What is the cash flow from this asset I am going to generate? So if the cash flow from this asset is 12,000, that means हमारे बुक्स में हमने जो वैल्यू लिखा है वो 10,000 है, लेकिन हमारा कैश फ्लो बोल रहा है कि आपको इस एसेट से 10,000 नहीं, आपको 12,000 मिलना चाहिए. दैट मीन्स योर book value or current value is less than your cash flows. Then in that case, no impairment. That means because we follow a prudence principle, wherein we always try to overstate the cost and understate the revenues. Even if there is a small chance that you could incur a loss, even if you think that you can incur a loss, you need to book it into your books of accounts. And even if you are 99% sure that this is going to give me a revenue, you are not supposed to book it unless you are 100% sure. 100% you have to be sure before booking revenue. So because 10,000 is something which is going to give me revenues against 12,000, so what we do is, because my book value is less than my carrying amount or less than my cash flows, what I'll have to do is I'll have to restate the value to 12,000. That is what I'm going to do is I'm going to increase my revenue, right? But is it a guarantee that you will still generate 12,000 from this asset? There is no guarantee for that. And that's why when my book value is less than the cash flows, I don't do impairment. That means I don't reduce the value from my books. Because the value is not justifiable and the value is more, I still keep the value as non-justifiable in my books. Let it be at the lower value. But what if the value from my cash flows is say 8,000? That means what I am saying is incorrect. I'll not get 10,000. I'll get 8,000. And that's why what you do is you do an impairment. That means what you predicted is that you will get a revenue of 10,000, but what the market is saying that you will only get a revenue of 8,000. That means your mind is saying to you that there would be a loss of 2,000. There could be a less revenue of 2,000. And as the prudence principle says, even if there is the slightest possibility of reduction of revenue or losses, you have to immediately book it in your books of accounts. That's why what you do is because your current value is at 10,000 in your books of accounts, you reduce it to 8,000 by charging 2,000 as your impairment loss. Okay. So in that case, what you do is impairment loss account debit to asset up by 2,000. So it is much more logical if you understand it in this way instead of the matter which is written in your notes or any other things. So you need to break it down step by step. Impairment means that something is not justifiable. I have to check that. Asset means it should give me a future economic benefit of 10,000 or 12,000. If it is more than that, we are not supposed to increase the value because we are not supposed to record the revenue. So this is as per the US GAAP. There is a small difference between IFRS, but that is something which you may not be, you need not know that. They don't call it cash flows, they call it a recoverable amount. In IFRS, they don't use the word cash flow, they use it as recoverable amount. And there's a method to calculate recoverable amount as well. So technically, it is not that difficult in IFRS as well, but they have their own method to calculate it. So what they use is they use the present value of future cash flows. That's the only difference. So here what we are doing is we are just calculating the cash flows. We're not considering the present value or the future value. We're just calculating the cash flows. That's it. But in IFRS, what they do is they calculate the fair value of the discounted cash flow. That means you need to consider the time as well, and then there is a discounting factor coming in. So it's more kind of a rigorous measurement for impairment. Then the question would be, how much does it worth to calculate impairment? Like, what is the frequency where the companies calculate impairment? There's a high frequency that the company calculates impairment. Specifically in the telecom industry, they calculate impairment like every 6 monthly basis. So again, an important concept for your examinations. So inventory, accounts receivables, fixed assets, and under fixed assets, impairment test. That is something you should be like thorough about. You can always have questions, wherein you can always ask me on the WhatsApp group or wherever you want to put it. I'm happy to answer those questions. So, any questions on this as of now? Okay, so let's take a quick 5-minute break. And once we come back, we'll start with warranties. It is again one of the important things which is usually asked in the exams. And once we are done with warranties, you're primarily covered with the important things which can be there in the exam. Although there are a few other things as well, but then in the pre-CMA, you're just supposed to know all these things on a primary basis. Probably we can have a discussion on income tax as well. So income tax, warranties, and leases is something which has changed. So you need not be worried about leases as of now. Let's take a 5-minute break. And once we come back, we'll concentrate on about the intangible assets and the few things which are left. And I would also share you the question bank as well after the class in the group. Okay. So I believe everyone is back.
Yes, sir.
Okay. So let me just give you one more heads up. So in your CMA as well, or your FMAA or pre-CMA, you have a bit of an accounting to be to be analyzed, the one which we are discussing basically. Uh, like how the fixed assets are going to work, what is the valuation and all. So what I'll suggest that you should be concentrating on uh, is these topics on a primary basis when you're doing, or whosoever is doing part one, part two, or any of the things which if you want to address. So what you do is, yeah, so these are the topics. If you want to summarize the things, these are the, like if you see 3 and 6 and 10, then 11, then 10, 11, and then like 13. So 13 odd topics is something which you should be concentrating on if you want to score good marks in your CMA part 1. So these are topics which I have I have found out wherein there are majority questions being asked on these topics. So I'll tell you how you need to write it first so that it becomes easy for you to understand. Uh, Let me just tell you how I have written it so that just give me a moment. So what it does is you don't want to go beyond like 13 pages for these 13 points. Nothing should be more than 1 page. So if you can summarize the things in 1 or 2 pages maximum and complete all the concepts in 13 pages, because the topics are 13. So 1 page for one kind of a topic. If you cannot write a summary in 1 page, that means you need to make sure that you are not concentrating on the important points. Okay, so for what I mean by that is, yeah. So if you see this, this is the property, plant and equipment we discussed, right? Just let me download it. Yeah. This is something which we discussed right now regarding your property, plants and equipments. What it means and what sort of the methods are there and all those things. So this is it. These are the only important things which you need to remember, or you need to jot it down somewhere with respect to your property, plants and equipment. So it's a 1 pager. If you see, this is a 1 page which gets completed. All the MCQ questions are somewhere around these concepts. Somewhere around. And if you see this, the next if you turn the page around, it starts with your inventory, right? If you see this, there is a overlapping of inventory there. So just have a habit. Each and every topic should always be completed within 1 page. So for that, you have this A4 size copy. So maximum 1 to 2 pages. If it is extending to a certain second page, it is fine. It is not that somebody is going to scold you for that. But then 1 page is something wherein you have to close the things. If you cannot close it in 1 page, then you're just extending the things for you. And just use a blank copy. Don't use a something where is already somebody has already given you the notes, or somebody has already written something. Make yourself understand that what is important for you. Something, there would be some concepts wherein you don't need to write those concepts, it is already there in your mind, or you just need a reminder of it. Okay, so just make sure you do that. And then I can give you another example. This is with respect to your accounts receivable. The way you remember it is again important. So again, if you see this accounts receivable, these are the only points which I need to understand. These are the only points which I need to remember. And if I remember these points, I'm good with my MCQs. Every point given to you is written in the notes. So, and if you see this, if you see right here somewhere, you can see that I have written an example of 80, 320, 400. That means, what it means is, when I solved multiple questions, I used this format to solve it. And every time I got a 100% correct answer from it. So it is better that once you solve it for the first time, just try to put in the figures in your original, use a pencil to put it, and you will have the things in place. So just try to make a habit that you put it in a kind of a consolidated manner. Then you should be able to pretty easily handle it. So these are the topics. If you want to take a quick screenshot of it, you can have the screenshot. Let me just. Yeah, if you want to take a screenshot of it, these are the important topics which you should always remember when it comes to your financial statements in your CMA part 1. Take a screenshot of it and we'll just discuss upon a few more concepts. So in the pre-CMA, those concepts are not that relevant. Just an overview is fine, but then you need to like study it in deep. And then there is a cash flow statement as well. There is something related to cash flows as well. So once you read your notes, the one which has been provided to you either from Sargent, Glem or Hawk, whatever you are reading, there are a lot of things there. There are a lot of things in the material, examples, theory and all. Scrap that thing off. Just try to take the relevant for all these points, all the 13, 14 points which are there in nursery. And then you should be fine. So moving on from assets, let's move on to a bit of a liability thing. The first and the foremost important thing for liability section is your warranties. So warranties is something which is which has been given a prime importance in the US GAAP, because the calculation of warranties and how the things are going to be worked upon is kind of a bit tricky to a certain extent, but they have a specific things to be done for warranty. So that's why it becomes a bit more important. So initially, on a primary basis, the warranties are classified into two types. Okay, the classification works on two types. The first one is called as assurance type warranty. That is, it gives an assurance. The second is your service type warranty. Okay, I'll give you an example on this. What does assurance type warranty means? It is provided by manufacturers. Okay, and there is no additional payment. There is no dollar amount to be paid for that. But for service type warranty, it is optional. Not necessarily it would only be given by manufacturers. So there is no specific criteria for that. And it has a dollar value. So let's say you bought a television from, say, Sony. So once you bring in the television from the company, you by default get a warranty. And then they ask you that, okay, if you pay, say, for example, 2,000 rupees, you will get an extended warranty. So by default, the manufacturer is going to provide you a warranty for 2 years. But if you want to have the warranty to be extended, you pay just 2,000 and your warranty gets extended to, say, 7 years. So that is called a service warranty, one which has an extension. but the one which all by default comes. So if you buy a phone, you still get a warranty of 1 year, 2 year, 3 years, whatever the conditions are. Right? But then what happens is the accounting is different in both the cases. So accounting is different for both the cases. I'll tell you what it is. So if it is a assurance type warranty, or if it is an I mean, it is being provided by the manufacturer directly, at the time of sales, when you make a sales entry in the books of accounts, you record the warranty directly. That is an expense. So what you do is you book a provision. So you went to the store and you bought a fridge or you bought a television. Say for example, $1,000. You bought a television. That means for that seller, he's doing two things. The first one is he's recording the sales. So let's book the sales entry first. So let's say you're paying him cash. So for him, so this is from the point of seller's books. There is nothing to be done for the buyer. So buyer is fine. So he'll debit cash account debit because cash is coming in. And then he's going to record two sales. Credit with the value, say 1,000. Okay. But because he has sold something, there would be a COGS entry also, which he needs to pass. Because for every sale, there would be a cost. So then it becomes COGS account debit to inventory because his TV is going down, the value for the inventory. And how do you get the value of inventory? You still have the methods for valuation of inventory. You can either apply LIFO, FIFO, weighted average based on perpetual system, periodic system. Why we are doing it? Because we need this value during the sales time. So let's say the value was 750. So this is what happens when you do a sale. You sold a product. But immediately when you're selling the product, and if you are following, if you are following assurance type warranty, you'll have to pass an entry for provision recording your warranty expenses. Okay. So how do you record that expense? How do you record the amount? You record the amount based on your past experiences. So in the previous periods as well, there could be a chance that in the last year you had a warranty cost of say 15,000 probably dollars for 1 year. So it's kind of a rough estimation too. There is no method to calculate it specifically. Let's assume that it was 15,000. That means every month you need 1250 of provision on every sale for that matter. The value could be different. It depends upon how the management calculates it. There is no provision for that. The value is not important. The entry is important. So what you do is you record a warranty expense in your books immediately for every sale you make. Then you put it as AT, that is assurance type liability. That is a compulsory journal account or a ledger which you need to make if you're following US GAAP. It's not like you can only put it as warranty payable. No, it has to be specific. It has to be assurance type warranty. Assurance type warranty liability account credit. Liability account credit. So what you did, you booked an expense. So by this, what is happening is you're creating a provision for warranty expense booked. And whatever is the value, let's say it is say 250, 1250, whatever it is. The value is immaterial for us as of now. So this happens at the time of sales. Okay. So you book a sale entry, you book a COGS entry, then you book a warranty expense entry. This is your provision. So once this is done, this is done. So for assurance type warranty, this is the first step you do at the time of sales. But then what is going to happen is there will be some units which would be destroyed, which would come back to you for claiming. So what happens when you claim the warranty? So there would be a customer who would be telling you that, look, I bought this TV from you. This television set is not working. There is some kind of an issue with it. I want a replacement of it. It happens in the real life as well. So when you're claiming the warranty, what you do is because you have a liability already created in the books of accounts, you reverse this liability. Okay, so you put it assurance type warranty liability account debit, and then you again either you are going to pay him cash uh, because the TV, if it is not recoverable, if it is not something which you can repair as of now, you can always give him cash, or you can replace it with another television or another product. Inventory to be credit and based on the liability value which you have. Okay, but so that's what happens when you book a assurance type warranty. But what happens when you book a service type warranty? So on sales, of course, there would be a cost of sales and everything going in the same way. So there is no change in this matter. But you don't book a provision at that point. You don't book an expense basically through provision. You only record cash. That's it. So what you do is instead of booking a provision, the way we have booked it right here, you don't book a provision. You book a sale of service type warranty. You book a sale of service type warranty. So what you do is, because you're selling it and you're getting cash, so you debit cash or bank account by the warranty. So let's say how much is the optional warranty you're giving. Let's say it is 100, and then you credit not accounts, not assurance type warranty liability. You credit your service type liability. That's a unique entry which you need to pass in the books of account. So it is not a provision being sale for warranty service type being recorded. So you got cash, you're recording it that way. So somehow you're recording it as an income as well, and you're recording it as a liability as well for the same amount. And if somebody is going to come to take out this warranty from you, you debit service type warranty account and you credit cash or inventory the same way. But what happens is, in the second one, you don't return them cash. You only return them inventory. That's a major difference. So here it could be cash as well, because if you don't have the math, if you don't have the kind of a sufficient balance in place, here it is only inventory which you should return. So there would be a question in the exam. The customer is constantly telling the seller that he only needs inventory, or he only needs the product to be replaced. Which warranty he might be talking about? Only and only product he requires. It doesn't require cash. That means he's talking about service type warranty. This is an accounting which you should always remember. The cost of goods sold and sale are something which is not relevant. This is just for an explanation purpose. But then the things which you need to remember is this, the bottom one. What happens when you book a warranty, and what happens when you claim the warranty. So this is all about warranty. So just to sum up the things, two types of warranties. One is assured warranty or assurance warranty. The one is your service type warranty. Service type warranty is optional. You can take it at a separate cost. It is costable. It can be charged. It is chargeable by the seller. For assurance type warranty, it is a manufacturing specific. It will not involve any cost. It is already included in your cost of purchase. At the sale, you record a provision. For the other, you record a sale of warranty. On the claiming, you provide cash or inventory. On claim, you provide only inventory. So this is something which is kind of that in your pre-CMA to a certain extent. Rest of the things can be covered up when you join the actual classes and all. So so this is also covered in your to a certain extent in your FMAA portion. So once you have that in place, you can always give that exam as well. Then there is something called as contracts. Let's talk about a few things on contracts. Uh, Contract is something which you can always study later on as well. So that is something you might ignore as of now for the pre-CMA. So I have a few questions on pre-CMA on this part, section A. So I would be sharing these questions over the group. Whosoever is in pre-CMA can still do it. Whosoever is in FMA can still do it. The level is not that high because it's a FMA based questions, but it's a good revision to start with. So if you want to like brush up the whole concept before doing the CMA, it's better that you just quickly go through this 150 questions or 95 odd questions, and sorry, 150 questions, and you can always have a kind of a very good understanding of all the concepts over the CMA part of it. So what you can do is by default the for the A is the correct answer selected in every of the questions. Okay, by default. And you can always go and just keep on scrolling the questions. There is an explanation given to it for a correct, incorrect answer. You can always have a quick read it through and have the things in place. Any questions does anybody have on this? Because we would be moving to the ratio analysis, which is already covered in your CMA part 2 and also in your buddy mentor session. So that is something we would be covering in the next class. There is a formula sheet which has already been circulated. If anybody doesn't have it, you can always tell me. I can always share that sheet with you. So okay. So there we are left with like part B. In for your FMA part, I'm talking about whosoever is giving the FMA. The first was financial statements. You only have this much, which is there. Some is covered in your pre-CMA as well. The second is regarding your ratios or ratio analysis. It is there in your CMA part 2, completely covered. That's the same topic I would be repeating in the next class. That is on next Sunday. So on 4th of August, we'll cover the ratios. And then budgeting and CVP I have covered to a certain extent for FMA and CMA, pre-CMA kind of a thing. We are only left with ethics. So 4th of August would be your ratios. And then 11th of August would be your ethics. And then we can wrap it up on 18th for pre-CMA. If you have a specific topic to be discussed, even if it is for part 2 as well, I'm happy to discuss that separately on 18th. So 4th and 11th, we would be like winding up this pre-CMA session and FMA session. I would still conduct one more session on 18th, that is 18th of August, for any specific kind of questions or to be taken up. What I'm going to do is I'm going to share some more ratio analysis questions. Somebody was asking me during my buddy mentor sessions that they need more questions on ratios. So I would be sharing that in the group. So I can share you the screen for that matter. This was your section A for FMA. So FMA, CMA, it's basically kind of an overlapping thing, but then, yeah. So there are 123 additional questions on ratio analysis, only ratios. A few are basics, a few are taken over. So it's evaluation of inventory and so if you see this question, this kind of question would be given to you for your credit loss kind of a thing, the one which I was referring to. And you can always refer to this question. I'm sending this over and you can always have a glance at it. So once that is done, I'm actually done with the class for today. I will just share the things over the group. This was your section A. So C and D I've already shared. Section A and B, you can always have a look at that. If somebody wants it over the email as well, I can share that over the email. If anybody wants it over the email, that is also fine. Let me share it. Any other questions? Any other random questions you want me to address? I'm happy to address it for next 15 minutes. Let me just leave everything away. Okay, let me just check. Any questions, guys? Anybody has, or does anybody want to ask any other things? I'm happy to stay back for the 10 minutes. Okay, I've shared the details over the group as well and additional questions. FMAA. You have it in place. So any other questions, guys? Which you have in person, if you want to ask any other questions. Pooja, did you check that leverage question which was there?
Yes, sir. I checked them.
Okay. So were you able to like understand it how it worked or
Yes, sir. Now it's clear how it's working.
okay?
Sir, I have a question, but sir, it's related part two.
Yeah,
So,
take it. You can tell me. You can tell me right away.
sir, what does it mean by lines of credit?
Which credit?
Lines of credit.
Okay, line of credit.
Yes, sir. Line of credit.
Okay, line of credit is basically the time frame. So let me just give you an example there. So I'll give you a practical example to be very fair. Uh, for my ICICI bank account, see, I have ICICI bank account, okay, and in that account, uh, it's a savings account, it's a salary account which I have, okay, when I was in India, I had that account. But on that account, the ICICI bank gave me a line of credit. What it means is because my performance was good. I mean, like the balances, I was maintaining the balances, whatever the minimum balance was required, I was maintaining that. So considering my kind of accounts health, it was a very good health. So they offered me a credit facility, wherein although it was a debit account, so for example, if my account had 100 rupees and I do a transaction for 500 rupees, will that be allowed to me? Will your bank allow it? It will tell you insufficient funds, right?
Yes, sir.
It's because you don't have that much that much credit in your account.
Yes, sir.
But if you have a line of credit, then what it does is that although you don't have that balance in your account, it will still initiate the transaction for you. So let's assume that ICICI Bank is giving me a line of credit of say 200 rupees. The 100 rupees is my balance, and 200 is my line of credit. Now what it does is I can still be able to make the payments to anybody who I want to until 300 rupees. So that 200 is line of credit which is getting offered to me from ICICI Bank. So that's kind of a very layman's definition which I'm talking about. So technically speaking, it represents the borrowing limit. I'm not getting a loan instantly. I'm only getting a immediate credit for which I need to make the payment. So it is what it is giving is it is giving me a flexibility to make the payment until that line of credit amount is there. So it represents the borrowing limit and usually offered by the banks or these financial institutions. Uh, until it is reached, it is fine. So until I do a transaction until 300, it is fine. If I book a transaction of 500, it is still going to disallow it because that is beyond my balance, available balance plus my credit limit. So that's how so that is called as line of credit. It's similar to credit card. Do you use credit card by any means, or anybody of your friends might be using it? So
Yes, sir.
there is
I
a
know
credit
about
limit
that.
available, right?
Yes.
Can you
Yes,
spend
sir.
more than the
Exactly.
credit limit?
Sir.
No, you cannot. So, for example, if your credit limit is say 100 rupees, you cannot spend more than that, and
Yes,
then you
sir.
have to reconcile
Exactly.
it at the month end. Correct.
Yes, sir.
But the line of credit is something which is given to your debit account itself. It is not related to credit account. It's given to your regular account. For example, let me just give you another example. So if you take a loan from bank, okay, and what does the bank do is they have your primary account associated with that loan, and there is an EMI which will get deducted every month, correct? So you took a housing loan, and let's say the amount is 5,000, which is getting debited from your account every month. But because you are a good customer, because you are an honest customer, you have been paying the things, what the bank can do is bank can give you a line of credit over that account. So for example, in the month of July, by whatever reasons, you're not able to maintain the sufficient balance in the account, and today is the EMI payment date. What is going to happen is bank is going to debit that much amount from your account, correct? But if you don't have the sufficient balance, it will reject that EMI payment and it will charge you again, right, with the bank charges and all for the default. But if you have a line of credit, it will still process your EMI amount. And of course, once it processes, it will charge you the interest as well, because it's kind of a facility which the company is going to give you. So that's how the line of credit works. It's very, very kind of very, very common term, and it is being used in this in businesses very, very often. So this happens with suppliers. This happens with your customers as well, wherein what the customers do is customer come to you because and they ask you for some kind of materials. You give them, but you don't take the payment. It's kind of a credit sales you're doing, but there is a limit for that. Up to that limit only you can make that. So that's called a line of credit which you're given. Anything else? Any general questions you have about
Yes, sir.
leverage?
Thank you so much.
So just concentrate on solving the MCQs. The more you solve it, the more beneficial it would be for you while cracking the examinations. So the first step should be to just go through the notes, like do a rapid revision where you just quickly sum up the things. The second step should be to just put it in your own words, like a small summary. And the third step would be to just solve the practice question. That's it. So you refer to your notes, you solve the MCQs. You refer to your notes, you solve the MCQs. If you feel that, okay, this MCQ I was not able to solve it because, okay, this concept is new and because of which I was not able to solve this, so record that concept in your notes. Don't go to the original material again. It's kind of a very lengthy stuff. Just try to do it. You guys would be able to crack it. So there is nothing rocket science on that. Just a little bit of a practice is required. Once you do a systematic practice, you will have the results in place. So follow the process. Keep on doing the same thing again and again. Read the notes, read your material, draw your notes, MCQs. Once you solve the MCQs, again go back to your own material, the handwritten notes, again solve the MCQs. Again the material, again the notes. Again the MCQs. Just keep on following the same process. Should be able to get the things in. So you'll start slowly start to kind of recognize as to which questions you are comfortable with, which questions you're lacking on. Concentrate on those questions, you should be fine. If there is anything else, or else I'll call it a day for today. So I'm here for another 2 minutes. Does anybody have any questions? Otherwise, we can just drop off. Okay then. Thank you guys for your time. I appreciate you taking time on Sunday and spending about a couple of hours on your studies. Let's see you on next Sunday then.
Okay, sir. Thank you,
Okay.
sir.